Welcome at this meeting of the History and Methodology in Economics. And today's topic is related to the Great Recession and to changes in macroeconomic theory and economic policy. And basically, we'll talk about the challenges which became apparent due to the Great Recession of 2008 till 2010, and in some other countries, the recession lasted much longer than just for about a year, like in the US. What's so interesting on the Great Recession is that its start surprised many in the profession. In fact, only a few economists predicted the sources and the potential damage which will be caused by the collapse of the subprime market and by the housing bubble in the United States before 2007. The notable exceptions are Nouriel Roubini and Raghuram Rajan, who has been widely criticized for presenting his view already several years before that the changes in the financial sector, especially in the US, but globally, can trigger large crises within over a short horizon. But then the 2008 has come, and especially after September 15, 2008, full-fledged crisis started after the collapse of the bank Lehman Brothers. And the collapse of this bank led to immediate lack of liquidity on financial markets, and full-fledged financial crisis started. And this financial crisis, the stop of flow of money in the economy, caused the steepest fall in economic activity since the Great Depression of the 1930s. And very soon, not just bankers, but even economists and not only in central banks, but also in academia, simply everyone from the profession started to be asked why not having recognized the risk timely, and why we as economists did not provide it to reliable policy guidance to avoid such a large shock. And the shock was really large, although the fall of the economic activity, especially in the US, wasn't that sharp as it's been in the Great Depression, where 4 years after the peak in 1933, the economy was almost 25% below its pre-crisis level. Here, the crisis lasted shorter. Already at the end of 2009, the economic activity turned it back upwards, and the fall was only 5%. But still, this rate was unprecedented in comparison to preceding decades. But as we can see on this plot, the recovery was markedly slower than was the recovery in the Great Recession. And after about 10 years after the Great Recession, we can see that the two crises have several things in common. And it is that that the long-term growth was the record of the long-term that after seeing the performance of the economy about a decade after the crisis, the performance is not that much different. So here we were able to avoid by timely policy action the sharpest fall in the economy, which happened in the 1929 till 1933, but the recovery wasn't very fast either. Why this has happened, why the crisis wasn't predicted, and why then it's been quite hard to find consensus on the appropriate policy response. One of the common feature between the Great Recession, the Great Inflation and the stagflation of the 1970s, and also the Great Depression, is that in the preceding periods before those crises, there's been a period of rising consensus among economists about a proper economic policy and also about the tools for macroeconomic analysis. As noticed by Olivier Blanchard and Lauren Summers in their 2017 paper on rethinking some macroeconomic policy, the confidence on policy was based on confidence that deep understanding of the economic the dynamics of the economy has been achieved. So in 1960s, it's been widely believed that the business cycles are a matter of past, and that the policymakers can exploit the Phillips curve to avoid large busts in economic activity and to simply fine-tune the economy. Similarly, in the 2000s, it wasn't about Phillips curve, but we also had a framework on which there's been a broad agreement in the profession. And the consensus was were the new Keynesian DSG models. And the new Keynesian DSG models, which were so frequently used by the central bankers and when doing the monetary policy, were given a credit of providing solid policy guidance, which provided a framework for policy that contributed to unprecedented smooth era of economic growth, not really interrupted by any major crisis, which started at the beginning of or in the first half of 1980s, and which has been called in 2000s as the Great Moderation. Again, it's been believed that the economic policy, especially the monetary policy, is able to smooth out the business cycles completely. But if such a large shock has appeared, and even the British Queen Elizabeth II published or sent her famous letter to economists to explain her why there hasn't seen the crisis coming, then obviously the economists had to react, and the failures of the pre-crisis consensus were actually quite quickly recognized in the profession. And this presentation is very much inspired by a series of 4 papers written by Olivier Blanchard and his co-authors at the IMF, and then finally at the Peterson, and then by together with Larry Summers and published at the Peterson Institute of International Economics. And in those 4 papers, we can see first, in the first paper from February 2009 already, so it's just a few months after the collapse of the Lehman Brothers, the first reflections or systematic reflections of the failures of the current economic theory. And there are several key points, which are stated already there quite quickly, quite fastly after the crisis has appeared. The first one is that not all the booms are alike, and that there are some booms which can be sustained, and there are some other booms which are fueled by speculative money, which are not sustainable, and that economists for sure have underestimated the role of finance in the economy. Also, there is a hint or guidance or advice that the future monetary policy shall focus on financial policy much more than it used to before the crisis. On the other hand, the paper is still rather salient about fiscal policy, and on the fiscal policy, it's just said that perhaps having sound fiscal policy in booms doesn't assure that the policy will appear sustainable even in the crisis, and that you can really accumulate large debts in the crisis. Then we have here a paper which has been published in February 2010, so about a year after the first one, Rethinking Macroeconomic Policy. Perhaps this is the most famous and most quoted paper of this series. And here it is already visible that, for example, the role of monetary policy is is being discussed in more details, and it is much more discussed whether really inflation targeting was the right approach to monetary policy, and whether the role of fiscal policy should be really limited. And even the nature of the great moderation is questioned in this paper. And for fiscal policy, it is firstly acknowledged that fiscal policy can play an important role in stabilizing of the economy. And also it is here asked how fast we shall try to eliminate the debt accumulated in the crisis, whether the fiscal consolidation shall be front-loaded, as it was especially in the euro area, or whether it should be postponed for the better times. And first attempt to provide really consistent and sound implications for the design of policies is provided here in 2010. Obviously, other papers were published which try to do the same, but here I'm just focused on those papers, mainly from the IMF, because they create a nice sequence where one can really spot nicely the evolution of those theories. Then we have the paper from 2013, where the authors wanted to or aimed to get granular and they ask really great questions. For example, they ask whether the central bank should start explicitly target economic activity, so not just the inflation but economic activity as well. Then whether they should target somehow financial stability, and that they should perhaps develop a framework to do that. Then obviously, how should the central banks ideally deal with the zero bound, because it wasn't clear in advance, because the zero bound and the possibility of a liquidity crisis or liquidity trap was considered as a special case that appears in textbooks and in Japan. And in Japan, it appears only because of accumulation of policy errors and not something that could be here persistently. And again, here we are asking much more whether what are the dangers and what are the potential implications of large public debts, and how we can design better policies for the future, especially how we can combine monetary and macroprudential policies, whether the macroprudential policy shall be considered in line with the monetary policy and attributed to the same body, or whether they should be independent to each other. And finally, there is the last paper from 2017, Rethinking Macro Stabilization Policy Back to the Future, which is much broader and where the long-term damage of the crisis is on economic activity is recognized, and it goes into much more controversial topics, so like whether the inflation targets should be increased perhaps, or how shall we even restart the inflation is being asked. There are some hypotheses that we are perhaps now in a period of long-term stagnation with, and what might be the causes of the very weak recovery in comparison to the previous recoveries after the previous recessions which have appeared, and whether, for example, fiscal policy should be not only active in stabilization of economies, but whether also the fiscal policy, whether even the debt finance investments in the area of very low interest rates shouldn't be used to boost the long-term growth via financing innovations, via public investment that should enhance the overall productivity of the economy. So in those papers, they nicely show how the attitude evolved, first from recognizing that finance matters, finally to discussion about the whole framework which we are using, that something has really changed in the economy. And what has been revised, or what is supposed to be revised? Well, it's good to review what were the elements of the pre-crisis consensus among economists, and what are the suggested revisions of the pre-crisis consensus. So in the pre-crisis consensus, it's been believed that the macroeconomy is not subject to hysteresis, so that there is a symmetric reaction of recession and then expansion, and everything is supposed to adjust relatively smoothly, and the pre-crisis trend is usually restored after crisis. So additionally, it's been assumed that regarding fiscal policy, that the crowding out is present. So it doesn't much sense to expand fiscal policy, because that would crowd out the private consumption, and the overall effect on the macroeconomy would be very low, if any. The reactions of output to monetary and fiscal policy were considered in nominal rigidities almost exclusively. Furthermore, it's been believed that the macroeconomy is able to stabilize itself on its natural rates, on its steady states. And there's been also a belief in the so-called divine coincidence, that stabilization of inflation should automatically lead to stabilization of output, of which the supremacy of inflation targeting as the appropriate policy has been derived. Because otherwise there wouldn't be the legitimacy of that. If only stabilization of inflation would lead to stabilization of, or if the attempts to stabilize inflation would just stabilize inflation, it won't be, there is not assured that it should be appropriate policy. But if it stabilizes also output simultaneously as a byproduct, then it's much bigger deal and much bigger story. And finally, the pre-crisis consensus about financial market was that the efficient market hypothesis hold. That means that the markets are full of rational agents, and that there are no bubbles, or that the bubbles are perhaps just a temporary thing, and the equilibrium is then restored quite quickly without any large losses. On the other hand, after the crisis, we see that the financial sector imperfections are are a feature, not an exception of the markets, and that those complexities of financial markets, such as the variety of instruments which is used there, really might matter. Furthermore, we have learned that financial crises are not limited to emerging markets and might not be associated with apparent policy failures which preceded the financial crisis in a very short period of time. We have also learned that economies are not necessarily self-stabilizing, and that even temporary shocks can have permanent effects on output growth. Finally, regarding policies, we have learned that monetary policy is not omnipotent, that the monetary policy reached a zero bound, and it's been quite difficult for policymakers to increase the inflation and to return the inflation back to the targets, and to normalize the interest rates, so that they will be able to use the interest rate policy in the next recession again. Because in recessions, the interest rate usually fell in the US by 5.5% on average in the second half of the 20th century. But if we have the interest rates around 2% or then above 0%, it is impossible to lower them that much, and other tools have to be used. Simultaneously, the role of fiscal policy in output stabilization was a little bit reappreciated, even though we are still aware of potential risk of mismanaging fiscal expansion. And finally, it is widely acknowledged that macroprudential policies need to be added to the main framework of economic policy, although there is not yet a consensus how exactly the macroprudential policy shall be implemented and what are its potential effects. What is perhaps most apparent and best illustration of a need to react with a different perspective on our models is that the crisis had apparently permanent effect on output in developed countries. Here you can see on a plot how the real GDP evolved in the US and in Euro area, and how also the pre-crisis trends or the extrapolation of pre-crisis trends look like. And you can see that in both cases, in case of United States and even in case of Europe, you cannot, you see that the post-crisis development of real GDP is well behind the expectations if the expectations would be driven or be linked to the pre-crisis output growth. Clearly, the post-crisis real GDP was permanently affected by the financial crisis, and the GDP has not returned to the pre-crisis trend. What will happen after the COVID crisis is yet to be learned. It shall be perhaps added that the changes in the trend of real GDP is not something entirely new. Here you can see the fit of the pre-crisis of the trend fitted on the data since 1945 till 1971, and then extrapolated to the future. And you can see in the plot that during the 1970s, the real GDP falls or went slightly below below the trend line, but still is quite close to it. But then the sharp recession connected with the disinflation, with the Volcker's disinflation in the United States, then brought the real GDP on permanently lower path, and the pre-1970s trends hasn't been achieved any time in the future. And here again, permanent effect of this recession is visible again. So the possibility that that crisis might have permanent effects on output, this is not something that should be entirely new. Still, such a possibility has been excluded by assumption from the mainstream macroeconomics models that we were using and that we are still using in macroeconomics. So the policy challenges which are here and which are still here even a decade after the Great Recession is that monetary policy that for monetary policy there's a risk of the liquidity trap. There's also a clear recognition that quantitative easing and forward guidance might help, but their potential to restore the inflation is limited. And there are also potential side effects in terms of generation of other asset price bubbles and also of their impacts on inequality. Furthermore, we are learning that the low interest environment might create excessive risk taking, which then can set the path to the next financial crisis, even though we don't know yet how it can be formed and how it can when it could happen. Also, it's been proposed that perhaps the monetary policy shouldn't really target the inflation, but it perhaps shall revise the target from the inflation rate to nominal GDP targeting, which would efficiently lead to an increased inflation target, something which has been considered as inferior solution and unoptimal policy before 2008. Is now even adopted from time to time by central banks over the world, including the American Federal Reserve Board. There are also many perhaps even more difficult implications for macroprudential policy, for successful undertaking or for successful performance of macroprudential policy. We would be happy if we have a canonical model of financial crisis that could be used for predictions, and that would allow us to predict when and whether the monetary policy, for example, or the macroprudential policy shall lead against the wind and limit the credit-fueled boom, whether the problem in the economy is still about solvency or whether it is just about liquidity and liquidity provision shall do the job. It's still not clear whether the simple rules such as setting the capital adequacy ratios would be enough or whether we need a more complicated tools and a more activist approach to macroprudential policy than is perhaps now being recognized. And there is also an interesting implication for fiscal policy, that if the low interest rates and that if the interest rates are lower than is the average the growth rate, then it might be even optimal to finance investments via public debt. And the public debt will be paid by the increase in public debt could be under certain scenarios paid by itself by the increase of the GDP. Finally, let us just let me just end up with this talk with one citation of the paper of the already mentioned paper by Blanchard and Summers, that the previous major crisis profoundly changed both macroeconomic and macroeconomic policy. However, the question is whether this crisis, the crisis of 2008, should and will have similar effects. Blanchard and Summers believe that it should, but they are less sure that it really will. And whether it will or not, this is something what needs to be seen yet, which is not clear. Now, thank you for your attention, and see you at another talk.